So if you have a company and you're thinking that you want to make it more valuable for the future, what should you do? First and foremost, and frankly most obvious, is building earnings capability. All buyers look at how much you can make from the company that you're buying. They look at performance typically as they look at EBITDA, earnings before interest, taxes, depreciation. They want that to be high relative to sales. Good plastics companies might have EBITDA at 18% of sales, maybe even 20 or a little higher. That's great. Weaker companies might have EBITDA at 5% of sales. Plastics companies, people always ask what they trade for, what kind of multiples they trade for. And I'll talk about that, but it's not a fixed rule, but something in the middle market size, in that $20 to $200 million range. A lot of those trade for maybe 5 to 7 multiples. The guy who's 18% of EBITDA is probably trading for 7, maybe higher. The guy who's who's making 5% is probably trading at the low end of that, maybe a 5 multiple. Now, after saying that and giving ranges, I would say if you get really good competition on the deal, multiples go out the window. They don't mean anything. We once sold a $30 million company making $1.5 million in income for $80 million cash. This is like a 50 multiple. It makes no sense at all. They had the best customers in a very narrow segment. They had half the Fortune 500 in this one little segment. And everybody wanted access to the customers. So everybody paid a fortune to do it. It's pure competition, and that's a lot of what our job is. We want to find the right competition. There's a quote that I like, kind of a strange quote. Al Capone said you can get a whole lot more with a kind word and a gun than with a kind word alone. The next significant predictor of value might be the customer segment, medical, pet products, those kinds of things. Those can make a big difference. Buyers also look for the status of PP&E. Older plastics processors tend to get a little sluggish about reinvesting in new equipment. When a buyer comes and he says, wait a minute, I'm going to have to replace everything here is over 5 years old. I'm going to have to replace half the stuff. If I'm going to have to put in $5 million in CapEx in day one, I'm probably going to subtract it from my price. So it's really important to try to keep current. We're selling a company right now that just took on, not a huge, but it's about a $2 million piece of equipment. With that, in March this year, they're being paid on the basis of an EBITDA that was 12/31/15. They didn't have that equipment. It didn't make a dime for them. So we're saying, buyers, you need to pick up the $2 million of debt on the new equipment too. Some will, some won't. We'll see how it evolves over time. But we didn't get any EBITDA for that. And our sellers owe $2 million for it, so we're going to try to get it covered. Buyers also look for anything at all proprietary about what the company does. Exceptional speed, great finishing capabilities, all of those kinds of things that really cement them with their client. And buyers look for not too much scary customer dependency. What's scary to a buyer? I don't know, one customer at 20% probably is a little worrisome. We sold a company years ago. One of the first companies we sold had a 70% customer dependency on Whirlpool. Well, as we talked to buyers for that company, 9 out of 10 just said, nope, no thanks. We ended up finding buyers, but the buyers we found were the ones that wanted access to Whirlpool. They were the ones that stayed for that company. We sold it and we did okay. But it was a tricky deal, a lot of work. Sellers can build things into their action plan to really help those kinds of issues over time. A lot of my guys say, if they could have any company, if they had 3 years to work on it, they could make the value worth double. which is kind of interesting. I think sellers can do that themselves. We do a project called a salability analysis sometimes. We charge $10,000 for it, and it's kind of a quick look at approximate current market value and what are your strengths and your weaknesses for sale. It's kind of a healthy process. Sellers can go then fix those weaknesses, hopefully, and make their companies worth a lot more. Any questions from this group about, the whole process of preparing for sale?
How long does the process typically last?
The selling process itself, we normally do in 6 to 8 months. We have a year contract. Sometimes we just close one in January that was about 4 months, sometimes faster, but usually 6 to 8 months.
What criteria does a company have to undergo a salability analysis? I understand some guys just, they see the end of the road, they want to retire.
Right.
When do you recommend a salability analysis?
Probably 5 years before sale, ideally. Often owners aren't real good at fixing those weaknesses for sale. They don't know how, or they would have fixed them already. So it takes a little bit of time to really benefit.
Talking again about right time to sell, back to some of your earlier points, connect with this. Do you wait a while till you invest the CapEx in new equipment and make your investment before you sell the company? A while before, do you look at a more diverse customer base so you're not relying on 1 or 2 customers before that? Building up to a sale, how far back should a seller think about going, and what should they be doing before they get to that point where a buyer might be interested in buying them?
They should be doing things like, when we talk about owner dependency, one of the key owner dependency issues is customer connections. Sometimes owners feel like they have to have all the important customer connections themselves. That's not healthy. If you want to sell, you should be making sure that customer has connections at 3 or 4 points in your organization so that you really strengthen that, so that it's not all on the owner's shoulders. It really can make a big difference. Diversifying business so that you're not dependent on one customer is critical. Maybe you put a little more sales effort into the new client. Maybe you give a bonus to salesmen for new accounts over a certain amount. You do different things that can really help value over time.
Do you replace your old equipment too more regularly if you're thinking about selling in a few years?
It helps to, yeah, it does help to do that. It's hard to play catch up. If a guy hasn't replaced his equipment for 20 years, it's an expensive process. The company that we're doing now has CapEx fairly regularly that's pretty significant. They're growing really well. So a new customer will require something they don't have the machinery to do yet. We talked to them about, should we wait? This $2 million expense was coming. Should we wait until that's digested? And we kind of concluded, no, we'll try to get paid for it because we'll probably have another one next year.
A lot of the company owners that we talk to say that they're getting phone calls from potential buyers all the time, even if their company's not for sale. That,
right.
They're getting phone calls from
every
private equity people every week.
That's
so
right.
You're talking about more of the idea that, so I would imagine that a lot of them come to you and say, I know who's going to be interested, I know who's going to buy me, and they can give you a list.
They do a really bad job of it. I mean, honestly, it's really a good process, but owners get calls every week, week in and week out. And I could tell them some things to do to make that calling process a whole lot more effective. I mean, first of all, they need to figure out who's calling. 75% of those calls are coming from intermediaries who are trolling for somebody who might consider sale that they can tell 6 possible buyers about and get a finder's fee. That's not worth much to the seller. That's not helpful. And they're not very careful about confidentiality. When a seller talks to those probes, he should first find out who he's calling for. Are you the buyer? Are you the president of a company that wants to buy me? Are you an intermediary, and are you hired by somebody to approach me? If they really are somebody who is specifically calling them, next thing to find out is, why do you think we could be a fit? What do you think? What do you like about it? What do you see as normal gross margins in this industry? What do you see as a good EBITDA percentage of sales in this industry? What do you expect growth rates to be? Find out everything you can about what that buyer might be looking for. And then you go on to say, what else have you bought? What'd you pay for what you bought? How did you determine price? Do you have a rule of thumb pricing that you use? Owners can't find out all of that, but they'll find out a lot, typically, as they talk to them. And if they save notes on that, that can be good information for somebody like us later when we go to sell them. But it is very difficult for owners to get that. They often don't know how.
Some of the things that people have talked about before, maybe in other times in mergers and acquisition time, like cash flow being important, that's something that hasn't come up. Do buyers look for a company with good cash flow? Does that matter, or are they really looking more at profitability?
No, they look at cash flow, but that is what they would judge profitability for. When we say EBITDA, that's kind of a swag at cash flow because it adds back the depreciation. What it doesn't do, and some buyers do, is subtract CapEx. If we have a company that's going to have to spend $3 million every year in CapEx, a buyer's going to look at that and say, oh, you spent that for the last 10 years, we're going to keep doing it. And he's going to subtract it from cash flow. So yes, they do look, and that's kind of what the shortcut EBITDA is for.
How about geography? A lot of times we've seen cases with, the company on the East Coast wants to have a West Coast presence or something like that, or
Absolutely.
automotive companies want something in the South. Are those things that you're seeing?
Yes. Absolutely, all the time. We often do geographic cuts of what our client mix is, and some buyers may be perfect simply because they're not close to us. They're on the other side of the country, and they need that, especially if it's big products that shipping costs are a big deal for. That becomes really important. Absolutely.